All right, okay, I think everyone can see me now. So hi, my name is Bjørn. I'm the head of business development at DigiShares. Just to give some sort of context, my background is from traditional finance, from Salomon Brothers and a number of asset managers in the US, Asia, and Europe. So my views will contextualize the type of discussions we're actually having with our clients and our ecosystem partners. Now, I think you could see my screen. Let's see here. Yeah, there we go. So just some warnings just in the beginning of the presentation. So this is going to be an opinionated overview on the current value proposition for tokenization for real estate. And there's going to be a fair amount of extrapolation. Focus is going to be placed on the fundraising and the financialization aspect. I'm also going to use quite a lot of financial jargon, so my apologies ahead of time. But you know, if there's one main takeaway, we are here to streamline your back-end processes. That said, I'm going to touch upon a few important themes emerging as a wealth tech provider in general. So given the current landscape and the bridges that we offer, what is the value proposition for real estate? We're currently in the tangible cost savings phase, which you can see on the bottom left-hand side, from streamlining the back-end processes. Looking at the overall picture where cost savings are intangible, because we're helping bridge a gateway to effectively conduct private placement of private markets, integrating with fintech payment rails and liquidity providers, that is something to consider. So far, the real estate is the killer app. In the public market space, it actually is a lot harder to reduce the cost of documentation and filing when dealing with regulated securities. But for security tokens, for example, by using long-form prospectus exemptions recently adopted for private placements, you could actually reduce costs just by doing that. In the US, there's the Jobs Act. In Europe, there's like ESMA prospectus exemptions under 8 million euros, for example. Increase in private placement filings has acted as a tailwind to try tokenizing. But the one thing I would like to emphasize is that the cost savings angle has yet to be articulated properly. In fact, in many public debates, you know, focus has been on the thematic attributes of blockchain, like immutability or certainty of ownership, even how you might replace good old-fashioned due diligence. But that is clearly not the case. What tokenization supports already is a streamlining of back-end processes, allowing issuers to lower the cost of managing their real estate through the investment lifecycle by using tech stacks like DigiShares. So that's once the assets are legally reflected on the platform. So the key phrase here is over the lifetime of the asset. So assets with long life and frequent administrative activities are really well placed for these type of cost savings. Meanwhile, I would say tokenization is ideal for owners of single assets or a small portfolio of assets. You know, one of the things that I'm going to go on to illustrate over the next few slides are the cost and liquidity, a characteristic of private markets, of which real estate and tokenization is the subset thereof.
Bjørn, could you full size your PowerPoint slides?
Full size. Let's see here. How do I do that? Let's see here.
I think it's the lower right corner.
Lower right. Let's see here. Lower right hand corner. Let's see here.
F5.
What's that?
Someone is saying F5, function 5.
F5. Let's see. Let's see, 1 second. So let's see, let me stop sharing. Let me try again then. Share the screen. Yeah. You don't see the full one?
No, we see the one with your notes.
Yeah.
I think you are if you full size it first, then you have to share the one that is full size and not the one with the notes.
Let's see here. Let's see, PowerPoint. Let's see here. Doesn't give this.
Yeah, you have to make it full screen first, then you share that screen.
Share, okay. So, what do I see here? Sorry, I don't get that functionality, to be honest. Yeah.
You should go under the view menu and then select full screen. There should be a view menu.
View, share full screen. Screen sharing. Hold on, I gotta stop sharing my screen again. Share view advanced. Let's see if I could just do it based on this, maybe.
That'll work.
Yeah, all right.
We'll live with that.
All right, there we go.
It's fine.
All right. Okay, so we're back to the illustration of the cost and liquidity characteristics of private markets. And I'm going to contextualize it as wealth tech dynamics. Real estate tokenization. Issuances year to date are mostly securitization of real estate assets, mostly single assets. But we're also seeing a trend towards funds like, for example, a core fund representing diversification across high quality commercial real estate, or value-added funds focused across more diversified types of crowdfunding real estate targeting higher returns. This is dependent on how much liquidity they could tap into emerging liquidity venues. Here we need to provide some macro overlay as some overriding themes for why security tokens will accelerate. So what you see here is on the left-hand side. This comes from a consultancy called Oliver Wyman. There's a pretty prominent report out from Morgan Stanley and Oliver Wyman that goes into this in detail. But it basically tells you here that the driver for the whole wealth tech management industry or assets under management in general will be retail, especially high net worth individuals. So this is statistics that they've come up with going through 2025. Now, on the right-hand side, you could see the enablers that are driving adoption, private markets, tokenization, abilities to customize and incorporate governance functions. And that's going to drive the growth in wealth tech, as well as security token adoption into retail, especially low to middle tier high net worth segment. So that is important to recognize this trend first and foremost. Real estate in fractionalized form is by far the most underrepresented of private markets. It is also what's happened to drive most of the security token issuance. Now, just to kind of define private markets, it's real estate, it's private equity, private debt, infrastructure, and venture capital. So in terms of accessibility, going exponential, it's coming from tech platforms enabling new distribution. It's coming from product innovation, tackling liquidity and diversification challenges, permissive regulation and new product structures allowing retail participation, and underlying blockchain tech improving market processes as well as new product introductions. So this market, private market segment, where real estate is the dominant driver, is expected to add $5 trillion of funds of AUM through 2025 globally, and retail slash high net worth individuals is going to add 1.25 million, 5 trillion globally. So this slide this gives private markets liquidity versus cost. And here I'm trying to illustrate the main difference with public markets and private market securities when it comes to liquidity. There's and cost. There's a fair amount of debate on how prominent this illiquidity premium is in explaining private market opportunities. But this explains one major factor proposition we have. That's bridging the liquidity gap via our tech stack with our bulletin board, with digital exchange partners, and possibly in the future, accredited investor silo dexes. Now, blockchain is global, but security market regulations that actually govern security token issuance are local. So despite the deregulation of private security placement regulations, we still have to bridge the gap between the global and the local aspect. Being protocol agnostic also means interoperability is more feasible with more liquidity venues around the world, making it easier and cheaper for real estate players to list their assets around the world. That can depend on to what extent that real estate projects has its own syndicate, for example, or their own network. So sourcing external liquidity can be done through these ATS exchange venues, and they're pretty much opening up everywhere in every time zone around the world. So in real estate investments, I guess there's a saying, you make money from opacity and friction. Yes, this will take away some of that, just like the saying software is eating the world. That said, by tokenizing your project, you are unlocking that value. Every time there's liquidity, you're basically unlocking that value. This exhibit visualizes our value proposition from our cost perspective into the three basic elements in terms of payment rails, token issuance, and cap table management. As far as now, there are primarily back-end processes that try to minimize admin costs associated with reaping the benefit of intangibles, such as removing friction, fractionalization, transparency, and promoting the issuer's brand. Functionalities are constantly being upgraded with regards to these three elements, and smart processing will provide more and more value add. More available data will allow issuers to do more quantitative assessments in implementing new functionality for their cap table management add-ons, such as voting, governance, and adding new features to improve stakeholder returns and alignment of interests. So I will illustrate these three basic elements just over the next 3 slides very quickly. So in terms of digital payment rails, so blockchain reduces the intermediaries in modern payment rails from 4 to 1 to the chain itself. A key bridging solution we provide is an omnibus wallet. That's to make sure you do not eat into too much on-chain network fees. The cost savings from reducing intermediaries such as banks at the very minimum required level should be able to generate substantial cost savings. Currently for example, some of the leading blockchain-enabled crowdfunding platforms, the minimum unit size is $1,000, and the average per security token issuance purchased by an accredited person is $30,000 to $50,000. So that basically tells you that transaction fees need to be kept as low as possible on the platform. And we could enable that by reducing bank fees through our API integrations with world-leading fintech providers. We could reduce slippage when it comes to money transfers, payment of dividends, distributions. slippage when it comes to clearing payment transactions, the subscription process, and certainty of allocations needed to be kept at bare minimum. And once again, focus on the omnibus account from a practicality standpoint of view, saving on gas fees. You do not have to necessarily have on-chain transactions in this format. You can incur gas fees when you need to move the tokens in and out of that ecosystem or the omnibus account. So by providing this picture in terms of digital payment, fintech payment rails, there's some value added. In terms of issuing the security tokens, one of the emerging use cases for token issuance comes from the customization and flexibility we provide by being protocol agnostic to be able to access liquidity across the world. So to meet local regulatory requirements, maintaining flexibility in terms of accommodating not just public blockchains, but private blockchains, that is one very good reason. There is still some debate about requiring permission structure, giving better control of processes like KYC, ML, accreditation within the financial services domain, especially institutional investors when comparing to high net worth and individuals. Although it seems that premise seems to be fading quite quickly based on our ongoing discussion with exchanges. Much more importantly, having the flexibility to access these venues across different time zones with access to different investment pools, some which may require bank-grade infrastructure, is a big advantage. And I need to emphasize that only the largest company issuers in the world and the public markets can do this, but you could do this in the private security sphere using tokenization. So this is something that fund management companies and private equity industry participants are noticing and showing very strong interest in. On the flip side of this liquidity aspect, there's another use case for being protocol agnostic. Rather than the liquidity, you could do structured finance within real estate by providing a deal structuring, by optimizing the capital stack, let's say within a single real estate project. You could syndicate to high net worth family office, special situation pockets with alternative investment managers that want equity-like returns with lower risk profiles. So sponsors, they could fill the gap between senior debt and common equity by raising mezzanine or preferred equity financing. Using DigiShares platform, this can be done seamlessly using fiat via stablecoins, a topic for the next seminar. This is probably, I would say, our most promising area when it comes to cost reduction and proposal, our proposition, our cap table management. As you can see on the left-hand side, with our smart IR functionalities operational already on the platform, this is really where a lot of our efforts are being placed. Given the customization benefits that can be offered when addressing what we see as a huge intangible benefit of tokenization, mentioned in this in the first slide at the beginning of the presentation. Both accredited investors and high net worth individuals are used to investor-friendly, efficient, and streamlined onboarding and reporting processes, which also pay heed to importance of cybersecurity. Besides improved capital raising, reporting, digital initial subscription documentation mentioned in the previous slides, embedded analytics and security measures can be automated by smart contracts using platforms. Now, accurate, secure, and real-time information exchange can help maintain confidence and add to the trust to the investor base you are eventually going to look to serve. Now, on the right-hand side, this is kind of to illustrate what sort of gains can be expected from advanced usage of a cap table management platform, which we offer. How we could reduce the cost of capital from the standpoint of investor relations. The idea that better investor relations lower cost of capital is not a new idea in public markets. So we're basically just copying this. There's plenty of academic papers touting this. One notable observation from my point is that what is happening now is terminologies like corporate sustainability although sometimes one suspects the end goals and the benefits of overemphasizing this, and the subset of ESG can give valuable insights for stakeholders in sustainability themes and data the issues has developed, and it could use it to advantage to lower cost. You could see that there are significant synergies to be reaped from using a platform for governance, increasing trust and brand loyalty, reducing capital over a long run. This exhibit on the right-hand side in particular, it measures ESG scores, and companies that adopt this are actually having a lower cost of capital, roughly 30 to 50 basis points. These are very large companies, MSCI World Index companies over the last 5 years. That is not a statistical error. Now, you might think that this is probably not as relevant for real estate, but the statistic is that for real estate, you actually see a 43 basis point improvement. It's actually ranked 3 out of the 12 top sectors. Not mentioned in this graph is a prominent example of this type of factor outperformance, with companies adopting sustainability goals and refining these metrics, like the Just Index, backed by Paul Tudor Jones, a relatively well-known investor, where he sees quantitative governance metrics playing a major role in performance of assets going forward. So empowering good governance on a tech platform, that's part of the democratization journey. That is better access to real estate assets like real estate. And just finally, just on a roadmap, some final thoughts. On the top, on the current, that is what was highlighted in most of these slides. They're already implemented and fully functional. In the near future, this is where things are heading, possibly as early as year end. The tech and the regulatory is already there. These are within ongoing discussions, like collateralized lending or DeFi yield staking on idle balances. And actually, just on a specific note with regards to prop tech and real estate, and this came up during a previous conference we had with the MIT Real Estate Forum, that is the mention of property valuation software and property management reporting to asset managers from softwares like Argus. So that's ARGUS. Any suggestions from the viewers are most welcome on what we could accommodate. And in terms of the last column, these are just realistic ideas coming during our conversations with private market participants that will improve trust, brand loyalty, and perhaps some gamification of stakeholder interests, driving community engagement and standing out. Extrapolating from private market trends overall, we think this is going to be a thing also for real estate. So that's the end of this presentation.
So there's a question here. I'll read it up for you, and you can see if you can respond.
Yeah.
Basically, do you believe your value proposition is created to real estate development projects or real estate that is already built and occupied, or is there no difference?
I would think there's, I would say the main difference is in terms of how easy it is to do fundraising, right? Because yielding products, existing products with established track record or established yield are more of a financial product than is something which is more project-based. So in something that is more project-based, maybe rather than tokenizing the equity, tokenizing the loan could be a better idea, for example.